Hello, everybody. This is Alan Elman, the Blue Collar Investor, welcoming you to this BCI video titled Collar Calculations Using the BCI Trade Management Calculator. We're going to be using a real-life example with Salesforce Inc., which trades on the New York Stock Exchange under the ticker CRM. Since the inception of the BCI Trade Management Calculator, or TMC, almost a year ago now, our members have been finding that it is a very flexible spreadsheet that has huge number of applications. Recently, several of our members have asked whether or not we could use this spreadsheet for collar trades. So in this video presentation, I'm going to show you, using CRM as a real-life example, how we can, in fact, use TMC for our collar trades. Okay, let's get started by defining the term, the collar strategy. This is a covered call writing-like strategy where a protective put is added to the covered call writing trade, therefore establishing a ceiling with the covered call strike and a floor with the cash secured put strike. Now, in this particular case, the put is secured by the stock itself. Now, this video will demonstrate how we could use the BCI Trade Management Calculator to enter our trades, generate initial returns, manage our trades, and then receive final results. And we're going to be using three perspectives. What if the price of the stock goes over the out-of-the-money covered call strike? What if it stays the same? What if it moves below the out-of-the-money put strike? So we'll be showing you those calculations in this video. And the way we do this, folks, is we deduct the put debit, the amount we pay to purchase the protective put, from the call credit. We always try to have a net credit. So when we deduct the put premium from the call premium, we should get a positive number, and that will allow us to have a profitable strategy. So what are the three legs of the collar trade? Well, number one, we'll long the stock. That's the first thing we do. We buy the stock. That will put us in a covered or protected position. Now, the covered call we sell is out of the money, higher than the current market value of the stock. So we're agreeing to sell our shares for a higher price than we paid for the shares, or that the shares were trading at the time of the collar trade. That will then establish the ceiling to the trade. So in other words, if the price of the stock goes higher than the out-of-the-money call strike, we will not participate in that share appreciation beyond the call strike. But we will get the appreciation up to the out-of-the-money call strike. Now, we then purchase an out-of-the-money protective put. And for puts, out of the money means lower than current market value. And that will then establish for us a floor. In other words, if the value of the stock goes below the out-of-the-money put strike, we cannot lose any additional money. So let's get started with CRM, which was trading on 4/19/2023 at $197.60. We purchase 100 shares. We're going to use one contract in this example. Once we own the shares, we can then sell the 5/19/2023. This is going to be a 31-day trade, as you'll see in a moment. Out of the money 200 call at $5.15 per share, $515 for the one contract. That will establish a ceiling at $200. Now we then buy to open the 5/19, same expiration date, 190 out of the money put strike. Remember, puts out of the money is lower than current market value. So 190 is lower than 197.60, of course. And the premium was $2.99, which I'm actually going to show you on this upcoming slide here. So you can see in yellow on the right side of the screenshot, that's the put strike, 190 strike, and the ask price was $2.99 a share. Now highlighted in brown are the call strikes. We're going to go out of the money with the 200 call strike, and that had a bid price of $5.15. So that just goes to show you the actual option chain on 419.23. Now first I want to show you the trade management calculator calculations for the covered call aspect only. That means the entire 515 premium will then generate, and the calculations show a 31-day, you see highlighted in purple here, return of 2.61%, which based on that 31 days annualizes out to 30.69%. You will also see in the pink cell over here that if the price of CRM rises to that out of the money 200 call strike, we will have generated an additional 1.21%. So these are the calculations before adding in the debit of the protective put. Now, let's move on to the collar trade, where we also purchase the out of the money protective put at the 190 strike for $2.99 a share. We deduct that from the 515, and now we have a time value return of 216. 515 minus 299. Now we recalculate, and we see that our return, still a 31-day trade, is 1.09%. It drops down, and that annualizes out to 12.87%. So what we're doing here, folks, is we're receiving a lower initial return in return for having the insurance policy of that protective put. Now, we still have the same upside potential shown in the pink cell here of 1.21%. Now, what are the three major outcomes at expiration? Well, the brown cells show if the stock price moves beyond the 200 strike, above that out of the money call strike, we will have generated an additional 1.21% on the stock side, in addition to that 1.09% initial time value premium when we add the cost of the protective put into our actual time value return. Now, the second possibility is that the price of the stock remains the same. And I'm showing you that now in the yellow cell over here, where you could see the return was 1.09% and no change on the stock side. Now, in the pink cell, what if the price of CRM drops below the 190 out of the money put strike? What if that happens? Well, if that happens, that means we're going to have a debit on the stock side of 3.85%. So let's now have a look at the final three perspectives. If the price of the stock goes beyond the 200 call strike, we will have a net return, 31-day return of 2.31%. This is the trade management calculator post adjustment after expiration. Now, if the price of CRM remains the same and doesn't change, we have that net 1.09% 31-day return. And then we have our max loss if the price of the stock moves below the out of the money put strike. When we calculate that 1.09 and deduct the loss on the stock side, that's a maximum loss of 2.75%. So you can clearly see the range here, a max return of 2.31, a break if the price doesn't move, we have a net return of 1.09, again 31-day return, and then the max loss of minus 2.75%. Let's summarize. Our collar trades can be managed with the TMC calculator by deducting the put premium for the protective put from the call premium. And we can establish using TMC both initial and final calculations using this spreadsheet. Now you can get more information using the link I'll provide by going to our website, thebluecollarinvestor.com, and clicking on Best Packages, and just check the BCI Trade Management System, which also comes with my 8th book, Exit Strategies for Covered Call Writing and selling cash secured puts, along with a 28-page user guide for TMC. Here's the link you could see with the red arrow for the best discounted packages. And you can go into our store, the bluecollarinvestor.com store, where you can also find information on the trade management calculator. Folks, I hope you enjoyed this video regarding the collar calculations using the BCI trade management calculator. A lot of our members have been asking about it. A lot of our members love the collar strategy. And folks, yes, you could use TMC to calculate your collar trades. Folks, I hope you enjoyed this presentation, and most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.